Welcome to the analysis for Wednesday, July 2026. Our stack of sources today covers geopolitical oil shocks, internal Federal Reserve debates, um, corporate capital raises, and a looming 2032 bond market collision.
Yeah, it is quite the list to get through.
My mission here is to strip away the Wall Street jargon and decode the underlying financial forces moving the world right now so you understand why these invisible levers impact your wallet.
The market mood as of early July is remarkably tense. I mean, undeniably fascinating from an analytical standpoint, but tense. We were looking at a landscape where investors are aggressively trying to price in long-term uncertainties.
I want to start with the most immediate risk engine on the board today. Imagine sitting in the driver's seat of a car. You are staring at a dashboard where half the warning lights are flashing red, but the speedometer just keeps climbing.
A very stressful drive.
You have your foot hovering over the brake, desperately trying to slow down, but someone else has wedged a heavy brick onto the gas pedal. The Federal Reserve is the driver trying to hit the brakes, and the sudden end of the U.S.-Iran ceasefire is that brick on the gas.
That geopolitical friction instantly reprices global energy and, by extension, debt.
We saw Brent crude hit around $78 a barrel, and West Texas Intermediate crossed over $73.
When oil jumps like that, the cost of moving every single physical good on the planet jumps with it. It is the foundational layer of the current anxiety.
Traders are actively trying to put a timeline on that anxiety. I was looking at data from prediction platforms like Kalshi, which shows traders betting there is only a 52% chance that normal commercial traffic in the Strait of Hormuz will resume by January 2027. We are seeing war risk insurance premiums soaring for freight companies. My question is about the validity of that 52% number. Wall Street has teams of analysts with satellite feeds and geopolitical insiders. Are these prediction markets actually reliable indicators of supply chain recovery, or are they just speculative noise?
They are surprisingly robust financial tools, actually.
Yeah.
They strip away political rhetoric to reveal cold, hard probabilities.
Because traders have to put their own capital on the line to forecast a January 2027 recovery date.
Skin in the game forces honesty. They're collectively synthesizing satellite data, shipping logistics, military posturing, and insurance data into a single percentage.
That honesty is telling us this oil shock is not transitory, which feeds directly into the bond market. It is the primary reason the 10-year Treasury yield recently hit 4.58%. Investors clearly fear sticky inflation,
Which was heavily debated at the Federal Reserve's mid-June meeting.
Chairman Kevin Warsh presided over what insiders described as a family fight. The committee's divided on whether the next move is a hike or a cut. They specifically pointed out that shipping disruptions combined with the massive energy demands of new artificial intelligence infrastructure are keeping prices stubbornly high.
The central dynamic to understand here is that the Fed rarely executes an isolated hike or cut. They move in sustained cycles to anchor public inflation expectations.
If they cut rates now, they risk signaling that they tolerate higher inflation, which encourages businesses to raise prices further.
And if they hike, they risk breaking the labor market. That internal fight is a direct reflection of a central bank trapped between a resilient tech sector and a fragile global supply chain.
The irony of relying on prediction platforms like Kalshi to price those global supply chain risks is that there is a massive financial battle happening right now over how these platforms operate. Wall Street loves to bet on everything under the sun, but suddenly there's a coordinated pushback when retail traders use these newer platforms.
Famous Big Short investor Michael Burry has taken massive positions in regulated sportsbooks, specifically DraftKings and Flutter.
His thesis is that the upstart prediction markets are exploiting a temporary loophole to avoid state gaming taxes, and he expects regulators to crush them. In the financial press, this is called regulatory arbitrage. Let's translate that into plain English. What does that actually mean, and who is pulling the strings to close that loophole?
Regulatory arbitrage is basically the economic practice of finding a gray area in the law to avoid taxes or compliance costs. Traditional gaming companies like DraftKings pay exorbitant state taxes,
They also have to fund massive compliance departments to operate legally.
while the newer prediction markets bypass those costs. They classify their offerings as event-based contracts rather than sports betting or traditional gambling.
Because they do not carry that heavy tax burden, their profit margins are incredibly high, allowing them to scale rapidly. So Burry's assuming the Commodity Futures Trading Commission, the CFTC, and state gaming commissions are simply going to wake up and declare that an event contract is just a bet by another name.
That is the core of his thesis. If the CFTC or state regulators step in and force these upstarts to adhere to strict taxation and oversight, their operational costs will skyrocket overnight.
Burry is betting on a predictable capital flow. When the regulatory loophole closes, the compliance costs crush the margins of the upstarts, and capital naturally flows back to the established, compliant players who already possess the infrastructure to absorb those heavy burdens.
As rules tighten and interest rates stay elevated across the board, the actual cost of money becomes incredibly expensive.
This creates a massive hurdle for companies trying to build the future. Look at the electric vehicle sector. Rivian just announced a 75 million share secondary offering to fund their new R2 SUV. Mathematically, issuing those new shares only dilutes current stockholders by about 6%, and it gives the company a critical cash runway deep into 2027. Yet the market fiercely punished the stock, dropping it 16% in response. I have to push back on the investor panic here. If an automaker explicitly needs capital to build physical factories, why do investors abandon ship when the company actually goes out and secures the cash necessary to survive?
To understand the panic, we have to look at the options market. Implied volatility for Rivian spiked to the 97th percentile.
Stop there. Implied volatility in the 97th percentile sounds like a phrase designed to confuse people. Break that down for someone who doesn't stare at Bloomberg terminals all day.
Think of implied volatility as the price of insurance against a stock making a wild, unpredictable swing.
When it hits the 97th percentile, it means options traders are willing to pay astronomical premiums to protect themselves from a crash.
It indicates extreme systemic fear. In a high-interest rate environment, debt is often too expensive to borrow, making equity selling more stock the only lifeline for a capital-heavy company.
The investors are not just reacting to this single 6% dilution then, they are projecting a trend.
The fear is a pattern. Investors are assuming 2 or 3 more follow-on offerings of comparable size will be necessary before the R2 vehicle ever hits full production scale.
The market aggressively discounts the stock today to front-run the anticipated future dilution of tomorrow. We are seeing that same pressure regarding massive capital expenditure play out in the digital realm too, albeit on a much larger scale. Meta is currently spending $9 billion to build a massive 1 gigawatt AI data center in Alberta, Canada. And that is just one project. Investors are sweating. Meta's projected $145 billion in total capital expenditures this year.
Wall Street is genuinely wondering how a social media company is going to monetize that staggering scale of AI infrastructure.
Just a quick note for you, if you want to explore more market dynamics and corporate strategies like this, you can find Financial Candy, Brain Candy, and classic audiobooks at clarineratio.com. It is truly fascinating how the financial incentives shift when we move from a company building physical cars to a tech giant building digital platforms. We have the celebrated platform economy where companies make billions connecting buyers and sellers, but their underlying business model structurally benefits from looking the other way when the rules are broken.
The fundamental unit economics of the platform economy rely on infinite scale with zero inventory and zero liability.
A digital platform generates revenue purely on transaction volume. They take a percentage of the sale or the booking, which means their primary incentive is to remove friction and onboard as many users as possible, not to rigorously vet the underlying asset being sold.
We are seeing the collision of that incentive structure with reality in the UK right now.
Local councils are actively sharing data with Airbnb to catch what the British government calls social housing fraud. They suspect around 6,000 public homes are being illegally sublet on short-term rental platforms by tenants who are profiting off subsidized rent.
The math on this is staggering.
Each voided case costs taxpayers roughly $105,000 because the government is forced to pay for temporary accommodation for genuine applicants and cover lengthy legal fees to evict the fraudster. In a parallel example, the consumer group, which found over 150 dangerous, officially recalled baby products still being sold by third-party sellers on Amazon, eBay, and TikTok. It is like a mall owner claiming they have absolutely no idea that the kiosk right in the center of their food court is selling illegal fireworks. At what point does the law force the tech platform to drop the Intermediary Act and assume the legal liability of a traditional retailer?
That is the existential threat to trillion-dollar tech valuations. If governments enforce strict liability, for instance, requiring Airbnb to physically or legally verify the tenancy of every host, or forcing Amazon to guarantee the safety of every imported good sold, the operational costs explode.
Because they would have to transition from a tech company to a massive compliance firm.
Exactly the opposite of their current model. The platform would have to hire armies of compliance officers and build heavy friction into their onboarding processes.
Friction kills growth metrics. The immense market value of these platforms is entirely predicated on the legal shield that they are merely passive digital intermediaries. Removing that shield and enforcing traditional retailer liability alters their profitability permanently.
We have spent a lot of time analyzing corporate debt, tech liabilities, and the immediate impact of interest rates.
Let's pan out to the ultimate structural liability looming just over the horizon. Research from the Mercatus Center and the Committee for a Responsible Federal Budget points to the fourth quarter of 2032. That is the exact date the Social Security Old Age and Survivors Insurance Trust Fund is projected to be completely depleted. If lawmakers do what they almost always do and simply use general tax revenue to cover the shortfall, it forces massive new government borrowing. Now, I have to play the skeptic here. We hear about the death of Social Security constantly in political speeches. It feels like a perpetual boogeyman. Is this just think tank fear-mongering, or is there a tangible mathematical trigger waiting for us in 2032?
The trigger in 2032 is not an overnight collapse of the federal government, nor is it seniors suddenly receiving $0.
So what is the actual mechanism?
It is a violent repricing of capital across the entire economy. If Congress uses general revenue to plug what will be a $600 billion to $700 billion annual shortfall, the U.S. Treasury must issue a tidal wave of new bonds to raise that cash.
This initiates the economic phenomenon known as crowding out. Break down the exact causal chain of crowding out. How does the Treasury printing more bonds connect to the listener's wallet?
When the government needs to borrow an additional $700 billion a year, their appetite for debt becomes so massive that it sucks all the available investment capital out of the financial system.
There is a limited amount of money globally looking to buy safe assets.
To attract enough buyers to absorb this unprecedented new supply of Treasury bonds, the government is forced to offer higher interest rates or yields on those bonds.
The Committee for a Responsible Federal Budget projects this specific flood of new debt could push the 10-year Treasury yield up to 6.6%.
And the 10-year Treasury is the benchmark for consumer debt.
Because banks base their own lending rates on the risk-free return of a 10-year Treasury, consumer debt becomes incredibly expensive. If the 10-year Treasury yield hits 6.6%, the standard 30-year consumer mortgage rate would be dragged up to nearly 9%. Car loans and credit card interest would scale up similarly.
So the government's failure to balance its own demographic books dictates whether or not you can afford a starter home.
That is a brutal, direct translation of federal policy into everyday personal expense. We spend all this time analyzing financial capital mortgage rates, stock dilution, the market capitalization of AI data centers, but I want to pivot to a completely different kind of capital. A recent CNBC survey found that 72% of Americans define the American dream purely as financial stability, while only 35% include community in that definition. Furthermore, according to the Harvard study of adult development, Americans currently spend less than 35 minutes a day socializing. We are aggressively optimizing for our balance sheets while completely bankrupting our social ledgers.
In our hyper-individualistic pursuit of financial metrics, we frequently abandon our social networks.
We move across the country for a marginal salary bump, or we work remote hours that actively isolate us from our neighbors.
The Harvard data makes a compelling economic argument. The ultimate safety net during a crisis is not a solvent trust fund or a high-yield bond portfolio. It is the community that actually supports you.
A pristine personal balance sheet combined with zero social connection is a uniquely modern, highly destructive kind of poverty. That takes us right back to our starting dashboard with the warning lights flashing. You can have the most expensive, highly engineered economic engine in the world, but if there is no one sitting in the passenger seat with you, the destination might not matter anyway. Something for you to mull over as you navigate the markets and the headlines this week. Maybe take an hour to invest a little in your social capital, too. Thank you for joining us for this exploration.